firstly look at how current income streams considered from a Centrelink perspective, and then we'll talk about how it might impact and change things over time. So let's just explain how Centrelink tests income streams currently. So we'll use Bill and Margaret, and we're saying that they currently are in receipt of the age pension. Now we're saying that I think Margaret here is going to start a Christian pension. So this is a Christian pension of $300,000. Now she's commencing it at age 65. And she's starting it before the 1st of January 2015. The purchase price is $300,000. So money from these needs to go through superannuation. So she's got to have $300,000 in super and then rolls it to pension phase. Now at 65, her life expectancy is 21.62 years. So what we do to work out the deductible amount for Centrelink purposes is we divide the $300,000 by the life expectancy and we get $13,870. This is what we call the deductible amount. And this reduces the amount that's tested for Centrelink perspective. So if she's 65, she needs to draw 5% of the balance of her $300,000 pension, or $15,000. Now, if she draws the minimum, or $15,000, then Centrelink is only going to test $1,130, because $13,870 is what we call the deductible amount. So she's drawing $15,000 of income, but Centrelink only test $1,130 of it. Now, if she chooses to draw, rather than the minimum amount, $15,000, she chooses to draw $45,000, then $31,130 is going to be tested from a Centrelink perspective under the current rules. So that's how deeming works currently, and that's why generally, if you've got super money and you're eligible for the age pension, it's best to have it in the pension phase of super. This benefit, where you're getting this deductible amount, but there's also the fact that it's tax-free earnings on the account, and what you draw from it is tax-free as well. So generally in the past and into the future, it's best to be in the pension phase of super. So if you've got money in super and you're eligible for the age pension, then often it's best to move to that pension phase. So what will happen when the new rules apply? So to illustrate this, what we're saying is that Bill and Margaret, again, they're still eligible for the age pension, but this time Margaret chooses to start the Christian pension with $300,000 at age 65, but she's still age 65 after the 1st of January 2015. And because she started it after the 1st of January 2015, it's the new rules that are going to apply, and the $300,000 pension will be deemed. We've used the same example as earlier, and she's got some other assets of $44,000 or $44,000. So the first, so $35,000 of the 300 is deemed at 2%, and the remainder at 3.5%. So the income that Centrelink will test under the new rules is $9,974. So you can see the difference. Under the old rules, it was $1,130 if the minimum was drawn. Under the new rules, nearly $10,000. So if you're drawing the minimum pension, then the old rules are better. If you were drawing a larger pension, sometimes the new rules can be better, because if you were drawing $45,000 under the old rules, then you would have been tested at $31,130. Whereas under the new rules, then this will apply, so just under $10,000. So it's not always going to be more advantageous to be under the old rules. It depends on how much you're drawing, but you can sometimes get around to this by drawing lump sums from it as well. So generally it's going to be best if you can be under the old rules, because of the flexibility of doing lump sum drawdowns. So hopefully that's explained how the old rules and the new rules work, the deeming versus not deeming. Now, those people that can take advantage of those rules, again, I'll just reiterate, are those that are in receipt of a government pension and have moved their money to the pension phase of superannuation.